Now I will be talking about this moment what is described on the paper 1, chapter 15, C.F.A. Investment Management Certificate. The paper 1 on this chapter 15, which makes part of paper 1, which goes up to chapter 17. This one just two before the last. This chapter say about the taxation of investment in the UK. First, you are starting talking about the taxation of direct investments. Saved incomes comprise interest when you invest your funds in a bank or bank societies, guilds, and corporate bonds. The guilds are issued by the government, which provide you income over the funds that you invest in there. The income in part of a purchase of life annuity, chargeable gains on life assurance policies. Some save income are paid in gross. As you withdraw the funds, they pay you in full, and then when you send your tax return or self-assessment, you declare, or in some case you need to make a report. In the case when you get your income and your fund in full, and it has not got tax deduction. The INEI, which is standing for National Interest on National Saving Investment. The interest on national saving and investment are held by the government. It's common since it was in 1861 by Palmerston, who was the exchequer, and then came into regulation after 1956, because after the World War II the government is started demanding for funds because had some problem at that time. Uh, their revenue are lower than their expense, so they start issue this interest national saving and investment. It used to be held by the post office management, and then in 1964 was changed to the HMRC. But anyway, there are three types of interest that are paid by the government on this NSEI, National Saving Investment. They have individual saving account and the premium bonds, and you also have an inflation linked saving certificate. The premium bonds, the person buy bonds and its interest goes into the funds, and every month has a price, as every bond has its number. If the bond holder get the price, its prices can be released to him free of tax. The price can start from £25 a month to the top of £1 million. It depends on the number and the value of your bonds. Of course, the higher the bonds, the higher the price. And there also has the inflation linked savings certificate. That's a limit for up to £15,000 per person. So they pay They follow the RPI, which is stands for Retail Price Index plus 1%. That's the amount they pay. And the same system in the with inflation linked savings has a granny bonds. The granny bonds, the person can withdraw the funds after retirement. Interest paid to individual investor by listed UK companies in relation to corporate bonds, debentures and the loan stocks held, gilt a UK government bond and interest. Some save income is paid to individual of net of tax, which is they deducted 20% from the top. If you have 1,000 to withdraw, they just give you 800 because they calculate 20% from the top. If you calculate from the bottom, will be 25%. So this amount the bank deduct from your fund when they release to you, you can put in a self-assessment or your tax return. But to claim this amount, you have to send the R40. You need to fill in the form to HMRC. As I have already said in a previous chapter, well, interest paid to individual by unlisted company in relation to corporate bonds. Saving comes from non-discretionary trusts. The income on portion of purchased life annuity. Well, all these are taxable. To calculate, first you pay. Savings income is added to your non-saving income, and then you deduct the personal allowance. Then you apply your tax rate according to the band that you are in. Up to 32,010 pounds, you know, is 40%. Above that, up to 150,000 is 40%. Beyond 150,000 pounds is additional rate, which is 45%. And the rental income from direct property investment is also liable to income tax, as the expenses running can be offset before apply the tax. If the residents in the house, if you have your own house and sell it, you are exempted to capital gains tax, and also because CGT we call capital gains tax is the only profit you have when you're on your property. But anyway, you are not taxable on it. Now you are starting talking about taxation of indirect investment, which is pensions, pension arrangement, pension contribution. An individual who is under 75 years old is entitled to tax relief on contribution to a registered pension scheme in a tax year. The higher rate taxpayer may have up to 40%, who is in additional is liable to 45, and who is in a basic rate, which is 20, they cannot claim anything, because when you join the pension scheme, as you pay the contribution, let's assume if you pay 40,000 in a year, so the government give you 20%. So actually you're gonna pay 32,000 pounds in a year. But in the case you are higher rate taxpayer, who pays 40%, you have right to claim 20%. It's just like that. If you pay in the same amount, 40,000%, they will give you 20%. You will pay 32,000 pounds. Then on top of that, you can claim another 20, but you need to prove that you are really higher rate taxpayer. You need to prove that you are paying the band of 40%. So those 20%, the difference. The firstly, when you pay 40 but you pay only 32, but they grant you 8,000 pounds. That's the government give you, the taxman give you 8,000 pounds, which is equivalent 20% on the gross value. The other 20% on top of the gross value, which is another 8,000 pounds, we can claim back on your self-assessment on your tax return. If you earn 45, if you earn 45 taxpayer, if you are additional rate taxpayer, which is 45, it's the same system. You pay 32, get 8 back, and you claim another 25%. So those 25 will include in your self-assessment on your tax return, and you claim 25. All the time you must prove that you are thus such a bond. And also there is a pension benefit, which is indirect as well. At a retirement, tax-free cash lump sum equal 25%. If you have your funds, you got retired today. Let's assume you have 100,000 pounds in there, your balance. If you take 20, you can take 25% of this amount with free tax. You don't pay any rate on top of it. But if you take the whole amount, you'll be charged 55%. So if you have 100,000, you take 25%, which is 25,000 pounds. Those 75,000 remaining, they apply 55% on top of it if you want to withdraw everything. Because sometimes you have some purchase, buy a house, or help someone, or lend to children, or whatever. You know, that's subject for 55% before you get that money. But this rules is applied up to 1,500,000 pounds. So that's the amount, the top one. And you also have individual saving account. It's not an investment itself. It's just a way to shield from taxation. Just rather up an investment to wait for a chance to jump into a bad investment, sometime long term, sometime you put in a ISA in order to cover something in a short period of time. Well, there are two types of ISA, investment individual saving account. Money invested in cash market instrument where there is no capital uncertainty, and stock and shares. Share and corporate bonds, gilts issued by the government. OEIC. OEIC, it stands for open-ended investment company. This is short term. It has it. They are related to VCT, with venture capital trust. But VCT you have you can claim 30% tax relief as far as live over 5 years, but up to 200,000 pounds. Yeah. You also have UC ITS, which stands for Undertake Collective Investment Transferable Security. That's when you go to a broker and he collects your funds and lets you know everything about, well, in the case the broker has to tell the client what he's making with the funds. Some invest in VW in Germany or BP or Mercedes or many other companies. They are available in there to issue stock to whoever wants to buy. Life insurance policy, there are annual limit that an investor can make in the current years of 11,520 in stock or 50% of that, which is 5,760. They can share in a cashing in the ISA and the other 50% in stock and share. So he exempted from taxation. The government has introduced in November 2011 JISAI because this is for children, a junior individual saving account. It's to children under 18 years old. Last year was the maximum that could invest in was 3,600. This year, from 13 to 14, is 3,720. And if you one of the parents receive income on that, are free tax. And investment in ISAI are exempted from CGT, capital gain tax. Onshore and the offshore collective investment scheme and investment companies, UK collective investment scheme, are exempted from tax on the gains made within the funds. Any income is taxed to corporate tax at 20%, and the management can be offset against this. The management of the expenses that you pay to broker and many other fees involved on the transaction can offset against the income before you apply 20% on behalf of the tax. The UK tax treatment for dividend distribution for collective investment is the same as the tax treatment of direct investment and or holding of equity, net of 20%. So when they pay you, they deduct the tax. An investor is liable to capital gain tax on the disposal of the collective investment scheme, include switching between sub-funds of an umbrella funds. That works like that. If you have a funds and you switching, you see other portfolio which you will provide more profit, and when you sell that portfolio you are holding, and you sell in order to collect the other one, and then in this case you are liable for CGT, capital gain tax, which is could be 18% if you are a higher rating taxpayer, or 28% if you are in the additional rate taxpayer. Investment trusts are exempted from tax on gain, but non-dividend income will be taxed at corporate tax rate. For offshore, there will be no tax payable by the funds, but some jurisdiction, a small local tax may be payable. The taxation of UK investor um, in an offshore fund will largely depend on whether the funds has reporting or non-reporting status. Because when you invest offshore, you must make a report to HMRC, and when you claim these funds back, you might not be able to reclaim the tax that was deducted from your funds in that particular country. Like if you invest your money in Isle of Man or Guernsey, Switzerland, Jersey, or Santa Lucia, Panama, wherever, because those countries tax haven, they don't have a bilateral tax agreement with the UK. So any tax you pay there, you are not able to claim and compensate against UK taxation system. The report found this distribution of such funds are paid in gross. And a UK resident will have to declare this amount to include both actual distribution received as well as the reported income. So you have to report to HMRC how much you invested in there, how much you took back, and they split it into income and your funds. But taxation, you don't have right to claim against UK's taxation. The reporting fund are not necessary when roll-up funds accumulate funds and income. You make a reporting just when investing and when you withdraw the whole funds back. Onshore life insurance funds. Let's assume if you have £100,000 life insurance bond to maturity to 20 years, you can withdraw 5% per year without being taxed. Let's assume 5,000 per year. If 1 year you don't withdraw any amount, in a year 2 withdraw 15. So as you have 5 exempted as 5%, 5,000. The following year you have another 5, but as the year 2 took 15 instead 10, you deduct 10,000 and remaining 5,000 to be taxed. Those 5,000 will be split into 2 years. So you owe in for two years on the base of 2,500, which is 5,000 divided into 2 years. Offshore life insurance bonds do not pay either income tax and capital gain tax, but does not reclaim the withdrawal tax as grows roll up, make it grows rapidly. So if you put your funds in offshore and don't claim back, just invest, reinvest, will be grow faster than you invest into UK, because in UK will be taxed every year. In the offshore they don't. They just tax them whenever you take the whole funds back. So there is also venture capital trust that up to £200,000 you invest within the period of 5 years you can you have a tax relief of 30%. Um, Also, this chapter we spoken about taxation, how it works, and then enterprise investment scheme that I have just explained all you need to know about 15 chapter 15. And finally I'm gonna speak about enterprise investment scheme. If the person has 30% or more in a company and they invest in EIS, which stands for investment enterprise investment scheme, he can claim 30% of the amount he had invested in there. Let's assume if you have over 30% as in a partnership and you join the enterprise investment scheme, you invested £100,000 in the scheme. So if you in your company at the same time you have over 30% and you have it there in EIS, £100,000 invested, you can claim as a tax relief £30,000 per year on behalf of this relief of EIS. But you need to contact HMRC, fill in the form, and make all procedures. Um, I'm going to stop here because in the chapter 16 is basically what has already been said in chapter 14 and 15. So 16 is basically we have already said. And then chapter 17 is more exercise based on what we have said so far.